Somnath, let's talk about fixed income. What is the percentage allocation that you are trying to tell your clients to do it right now? You've spoken about 20%, but also this dichotomy that different answers that I hear from different people, wherein some people say that closer to this 8% mark is a great time to buy into long-term bonds in India because typically they'll give good returns. What's your sense and what are you advising your clients to do currently?
See, the 8% benchmark is something that has gotten embedded in our psyche over several decades, I think a couple of decades at least. What we have to understand is India structurally has settled into a somewhat lower interest rate regime compared to what we were, say, a decade or decade and a half back. In India, fixed income today represents an interesting bouquet of opportunities. So, fixed income typically has two broad baskets, the high grade ones, which is your sovereign and AAA, and the high yield ones, which is everything that is sub AAA in the Indian context. In the high grade investment, the yield curve determines the value of the investing. The yield curve is quite crooked in India. So between repo and 6 years, you have 250 basis points of spread. Between 6 years and 10 years, you have basically 25-30 basis points of spread. So it's a no-brainer where you have to invest in or where the value lies. We think that the 5-6 year range affords a fairly reasonable value and probably quite close to offering compelling value for investors to come in. And there is a whole range of products. You know, Bharat Bond is a very exciting instrument to invest in. You basically take out the credit risk out of the whole equation and you're playing the rates and duration side of it. And at 6 years, likely volatility on the duration side is likely to be the least, even as rates kind of adjust themselves up. On the high yield front, which is everything that is sub AAA, the generic context is that Indian balance sheets, corporate Indian balance sheets have gotten cleaned up in a massive fashion in the last 6 to 7 years, thanks to NCLT and a range of other things. That has happened, which affords a wider choice to investors who are not terribly keen on taking extraordinary credit risks. Having said that, it is an area that requires a lot of discerning choice to be made. But if that choice is carefully done, they afford fairly reasonable rewards for the risks that are being taken.